Imagine for a second that you are sitting on your couch. It's a rainy Tuesday evening. You realize you forgot to buy coffee for the morning. Or maybe, just because it's been a long, brutal day at work, you decide you want a new pair of running shoes to motivate you for a Wednesday morning jog. You open an app, you tap a glass screen a few times, and you wait.
It is the modern magic trick, isn't it? We've all become so accustomed to it.
We absolutely have, because 15 minutes later, the doorbell rings, and the coffee is there, and maybe the next day the shoes arrive. But here's the thing I can't stop thinking about. Between that tap on the glass and that ring of the doorbell, a massive, invisible, high-speed relay race has just taken place.
It really has.
It involves algorithms, warehouses, trucks, and thousands of human beings moving in sync. And today, we're talking about the company that is arguably winning that race in India.
That's right. We are unpacking the story of Shadowfax. And the timing for this conversation, well, it really couldn't be better.
No, it really couldn't. It is Monday, February 2nd, 2026. And unless you have been living under a rock without Wi-Fi, you know that Shadowfax has just been the talk of the financial town. They just completed their IPO.
They did. It opened back on January 20th.
And it was a big one.
It's a massive milestone. But, it's more than just a stock market listing. They've effectively transitioned from being a promising startup, one that was, frankly, famous for burning cash, to a publicly traded logistics powerhouse that is actually turning a profit.
Right.
And that specific transition from cash burn to cash generation is rare enough in the Indian startup ecosystem to warrant a very, very close look.
Exactly. And I think before we get into the stock numbers or the profit margins, we need to answer a really fundamental question. Because when I tell people we're doing a deep dive on Shadowfax, the reaction is usually, oh, the courier guys or the delivery app.
Sure, the guys on the bikes.
Yeah. But when you dig into the sources, it feels like calling them a courier company is, well, it's missing the point entirely.
It is a massive oversimplification. I mean, if you look at their filings, specifically the red herring prospectus and how they describe themselves, the term is tech-driven third-party logistics platform.
Okay, that's a mouthful.
It's a lot of corporate jargon, I know.
Yeah.
But I prefer to think of them as the operating system for moving things from point A to point B in perhaps the most complex market in the world.
The operating system. Okay, let's unpack this. Because usually when we think of logistics, we think of heavy assets. Trucks, warehouses, guys in uniforms.
Fuel costs, tire maintenance.
All of it. But Shadowfax seems to be playing a completely different game.
They are. Their mission, essentially, is to solve the last mile problem. And for anyone not steeped in logistics theory, the last mile is the step that breaks your heart in your bank account.
Ah, I like that.
It's getting the package from the local distribution center to your specific doorstep. It is the most expensive, most inefficient part of the entire supply chain.
Why is it so inefficient? Is it just the traffic? I mean, that's what I always assume.
Traffic is a huge part of it, for sure. But think about the density, or rather the lack of it. A truck on a highway is moving thousands of packages at once. That's very, very efficient.
Right. Cost per package is tiny.
Exactly. But once that truck opens its doors in the city, those packages have to go to 1,000 different addresses, up elevators, down alleyways, past security guards who want to see your ID. The efficiency it collapses. So Shadowfax has tackled this by covering over 14,700 PIN codes. That's about 90% of India, and managing over 1 billion parcels. But here's the kicker. They aren't doing it by buying 1 billion trucks. They're doing it with AI and a massive gig workforce.
And that's the so what for everyone listening today. Whether you're an investor looking at this new IPO or you're just someone who marvels at how your groceries arrive in 10 minutes, this story isn't about cardboard boxes.
Not at all.
It's about artificial intelligence applied to the physical world. It's about the gig economy. And it's about a fundamental shift in how India shops, from the high-rises in Mumbai to villages that didn't even have reliable courier service 5 years ago.
Precisely. This is a story about the digitization of the physical world. It's the software eating the supply chain.
So where do we start? There's so much to cover.
Let's start in the engine room. I want to really understand what Shadowfax actually does day to day.
Yeah.
We mentioned they don't own 1 billion trucks. So what is the business model?
Right. The term that keeps coming up in all the research is asset light. It sounds great, like a diet soda or a cloud server. But what does it actually mean in a business like logistics, which seems so heavy?
Well, in a way, it cuts the fat. It's a good analogy. Think of Shadowfax less like a traditional company like FedEx and more like the Uber for packages.
Okay.
When you call an Uber, Uber doesn't own the car, right? And they don't employ the driver as a full-time staff member with a monthly salary and benefit.
Right, they're independent contractor.
They connect a demand, you needing a ride, with a supply driver with a car. Shadowfax does exactly this, but for logistics.
So do they own any trucks? Or is it all just software and vibes?
They do have some skin in the game, yeah. They have a fleet of over 3,000 trucks, and they manage about 3.5 million square feet of operational space.
So warehouses and things.
Fulfillment centers, sorting hubs, that sort of thing. You need those nodes to sort the packages and get them moving in the right direction. But the core delivery force, the army that actually comes to your door, is crowdsourced.
Crowdsourced. That word always sounds a bit chaotic to me, a bit uncontrolled.
Is controlled chaos. That's the secret sauce. They onboard over 200,000 gig delivery partners every single quarter.
Wait, hold on. Can you say that number again?
200,000
Per quarter.
per quarter.
That is a staggering amount of churn and recruitment. I mean, that sounds like a human resources nightmare to manage.
It is, but it's also a feature of the model, not a bug. These are people who might be students, they might be working another job, or they might be doing deliveries full-time across multiple platforms like Swiggy or Zomato.
Okay, so they're platform agnostic.
Many of them are, yes. Shadowfax provides the platform, the route, and the package. The partner provides the bike and the labor. In addition to that, they have about 17,000 contract staff who handle the more fixed operations in the hubs. But the real scale, the ability to flex up and down, is driven by that flexible gig workforce.
It really is the Uber model applied to boxes. So if demand spikes on a holiday like Diwali, you just try to get more gig workers online.
You incentivize them to come online.
And if it's a slow Tuesday afternoon, you aren't paying thousands of idle employees a salary.
That's the financial magic of it. It converts what would be a fixed cost salaries into a variable cost payments per delivery.
Yeah.
That is absolutely crucial for survival in a business that runs on razor-thin margins.
I see.
If you have high fixed costs in logistics and your volume drops by 20%, you die. You just bleed cash.
Yeah.
In their model, Shadowfax simply pays out less because fewer deliveries are happening.
That makes a ton of sense. Now let's look at the menu. What services are they actually offering? Because I see their delivery guys everywhere, but are they just delivering Amazon boxes or is it more than that?
Oh, it's much broader than that. They have 4 main buckets, and I think understanding the difference between them is really key to understanding their profit margins down the line.
Okay, let's do it.
First, you have standard shipping. This is your classic Ford logistics. You buy a shirt on a website like Flipkart, Shadowfax brings it to you. That's the bread and butter.
Okay, straightforward. Number 1.
Then you have the second bucket, reverse logistics.
Turns. The bane of my existence.
The bane of every e-commerce company's existence.
Yeah.
And this is a nightmare for most of them.
But why is it so much harder than delivering it in the first place? I've never really understood this. I mean, a box is a box, right? It's just going the other way.
You'd think so, but it's a whole different ballgame. Think about the state of that box. When you deliver something, you have a nice, new, perfectly sealed box, leaving a perfectly organized warehouse. When you return something, the courier has to go to your house. They have to check if the item is actually in the box. Did you put the shirt back or did you put a brick in there? It happens.
Oh, I'm sure it does.
Is the tag still on? Is it damaged? They have to do a quality check right there on your doorstep, repackage it if necessary, and then get it back into the system. It's messy, it's unpredictable, and it's expensive. Shadowfax specializes in handling this complexity.
That makes sense. I've definitely handed back some hastily taped up boxes in my time. Okay, what else is on the menu?
The third bucket is the one that is absolutely exploding right now. Hyperlocal and quick commerce.
The 10 to 30 minute delivery segment.
That's the one. Food, grocery, pharma. The I need milk right now and I'm not putting on pants to get it segment.
A segment I am very familiar with.
And finally, they have a personal courier service, which is consumer to consumer, or C2C. So that's you sending a package to your friend across town.
Got it. So they're essentially trying to cover every possible way a package can move.
They're trying to own the entire board, yes. And the scale of this operation is immense. We are talking about 2,500 cities. And as we mentioned, they cover 14,758 PIN codes.
I read that number in the source material and I had to double check it. It just seems so high. They doubled their PIN code coverage in just 3 years.
They did. From around 7,000 just 3 years ago to over 14,000 now. That is an aggressive land grab. It shows a clear strategy to go beyond the metros.
And in terms of volume, how many doorbells are we talking about?
They are processing 2.5 to 3 million orders every single day.
3 million orders a day, that is. My brain can't even really process that number. That's a lot of doorbells ringing.
It is. And look at who they are ringing those doorbells for.
Yeah.
Their client list is a who's who of the Indian internet. We're talking Flipkart, Zepto, Blinkit, Meesho, Domino's, the giants.
That actually brings up a point I saw in the notes that I wanted to ask you about, this idea of client concentration.
Yes, this is a critical detail and a potential risk. Historically, Shadowfax has been very, very top-heavy. Their top 5 clients accounted for something like 74% or 75% of their total revenue.
Wow. That sounds incredibly risky. If one of those big 5, say Flipkart, who is a huge one, decides to leave or build their own thing, that's a massive, massive hit to the bottom line.
It is a significant risk, and we'll definitely talk about that more when we get to the paranoia section later.
Okay.
But to their credit, they know this. They are actively trying to diversify. They are pushing hard into SMEs, small and medium enterprises, and D2C brands.
Direct to consumer.
Exactly. They don't want to just be the delivery boy for the giants anymore. They want to be the logistics partner for every small brand selling on Instagram or Shopify.
Okay, so we know what they do. They move millions of boxes using an app and an army of gig workers. But here is the question I always ask when we look at these tech-enabled companies. Is it really a tech company? Or is it just a logistics company with a nice website?
A logistics company with a fancy app.
Right. Like, how is this truly different from just using Google Maps and a big spreadsheet?
That is the multi-billion rupee question, isn't it?
Yeah.
And Shadowfax would argue very strongly that their moat, their defensive wall against competition, is built entirely on their technology. It's not just Google Maps, it's a whole different level.
So what are they using? What's the secret sauce here?
It's all about specialized data. You have to remember, they have delivered over 1 billion parcels. Think about that. 1 billion deliveries. That generates a unique data set that Google simply doesn't have. They call their system Shadowfax Maps.
But how is Shadowfax Maps different from the map on my phone? I mean, Google has spent billions on maps. They have cars driving down every street.
They do. And your phone map is great at taking you to a building, or maybe a street. But in India, as you know, addresses can be incredibly unstructured. Behind the banyan tree near the Blue Gate, Google really struggles with that.
Oh yeah, I've had that problem.
Shadowfax Maps knows that for this specific apartment complex, the delivery gate is actually around the back, not the front. It knows the security guard takes a lunch break at 2 p.m., so don't go then. It knows the elevator code for Tower B is 12354.
Ah, okay. So it's not just geocoding, it's operational intelligence layered on top of the map.
It is precise, granular geocoding. And when you are doing 3 million deliveries a day, saving 30 seconds on finding the right entrance, well, that adds up to millions and millions of dollars in efficiency. It creates a level of path optimization that just lowers the per unit cost of every single delivery.
So it's about squeezing every ounce of efficiency out of every single route.
Correct. But the tech goes even beyond just the maps. They have a system called Shadowfax Shield. This is their AI brain.
It sounds like a superhero movie, Proc. What does SHIELD do?
It does a few things. It handles fraud prevention and intelligence. For example, fraud in delivery is a real persistent problem.
Like what? People stealing packages.
People stealing packages, claiming fake deliveries, customers saying they didn't receive an item when they actually did. The AI looks for patterns in the data to flag suspicious activity in real time. But here is where it gets really, really interesting. It also does brand recognition.
Brand recognition? What do you mean? Like it knows what's inside the box?
Essentially, yes. The system can recognize if a package contains a high-value item, say a Gucci bag, versus a standard, low-value pair of socks.
Why does that matter to the algorithm? Why does it care what's in the box?
It routes it differently. If it's a high-value Gucci bag, the AI might assign that delivery to a highly rated veteran delivery partner with a proven track record of safety and reliability.
Okay, that's smart.
It might route it through a more secure sorting hub. It might trigger additional checks. It optimizes not just for speed, but for the value and security of the cargo.
That is fascinating. So it's not just get box to house. It's get this specific valuable box to the house in the safest way possible.
Exactly. And the company credits this entire tech stack for their financial turnaround. They improved their EBITDA margin from a negative 7%, almost negative 8%, to a positive 2.9% recently. They claim that is largely due to this kind of tech efficiency reducing the cost per delivery.
Okay, so that's the tech moat, the brains of the operation. But there was another moat mentioned in the research that I found really compelling. Network density. Can you break that down? Because density sounds like a physics term.
It is the physics of logistics.
Yeah.
It's a great way to put it. Imagine you are a delivery driver. If you have to deliver 10 packages and they are spread out all over the city, one here, one 10 kilometers away, another 5 kilometers in the other direction.
Right. You're spending most of your time driving and burning fuel.
Lots of driving, not much delivering. That is inefficient and expensive.
Got it.
Now imagine those 10 packages are all in the same neighborhood, or better yet, the same apartment building.
You can park once and drop them all off in 5 minutes.
Exactly.
Yeah.
Your cost per delivery plummets. Your earnings per hour shoot up. That is the power of density. And Shadowfax has achieved what they call entrenched density, especially in non-metro areas.
And how did they do that? Just by being first?
By being first and by aggregating volume. Because they have so many clients, Flipkart, Meesho, Zepto, all using their platform, a single Shadowfax rider isn't just carrying a Flipkart package. They might be carrying a Flipkart package, a meal from Domino's, and groceries from Zepto, all on the same trip to the same neighborhood.
Ah, so a competitor trying to enter that market
Has a massive, massive problem. If a new competitor wants to challenge Shadowfax in, say, a Tier 2 city, they might have the money to buy trucks, but they don't have the volume to make the road sufficient,
Their riders will be driving empty half the time.
or just carrying one package at a time. Meanwhile, the Shadowfax riders are full. That creates a powerful barrier to entry.
It's the classic chicken and egg problem. You need volume to get cheap, but you need to be cheap to get the volume.
And Shadowfax has already hatched the chickens.
Millions of them, it seems.
Millions of them. They have over 4,300 touch points across the country, hubs, centers, drop-off points. To replicate that, you would need a massive upfront investment to recruit 200,000 partners just to match their speed and cost. It's a deep, deep moat.
So they have the tech and they have the density. Now let's talk about the thing that everyone was looking at during the IPO, the money. Because for a long, long time, logistics startups were famous for burning money, not making it.
Oh, yeah. That was the narrative for a decade. Growth at all costs, get big first, figure out profits later.
Yeah.
Maybe. But Shadowfax has flipped the script.
Let's look at the numbers. Walk me through the turnaround story.
Okay. If you go back to FY23, that's the fiscal year 2023, they were deeply loss-making. Their EBITDA was negative 7.97%. They were losing money on every operational rupee they earned.
Red ink everywhere on the balance sheet.
Everywhere. Fast forward to FY24, they managed to hit break even. And now, looking at the data from the first half of FY26, the numbers leading up to the IPO, their revenue grew an incredible 68% year over year to around 1,800 crore.
A 68% growth at that scale is huge.
It's massive. And most importantly, their net profit, or PA, is now positive. They made about 21 crore in the first 9 months of FY25.
From huge losses to actual profit in just 2 years, that is a sharp, sharp U-turn. How did they do it? Is it just a case of delivering more boxes?
It's delivering more boxes, but it's specifically about a beautiful concept called operating leverage.
Operating leverage. Okay, we hear this term a lot in finance and business shows. Explain it like I'm 5.
Okay, imagine you run a lemonade stand. You have to pay €100 for the stand rental for the day, no matter what. That's your fixed cost.
Okay, got it.
If you sell only 1 cup of lemonade all day, that single cup has to cover the whole 100 rent. That's a very expensive cup of lemonade.
Right, I'm losing money.
But if you sell 100 cups, each cup only has to contribute 1 around to the rent. The cost of the lemons and sugar, that's your variable cost, goes up with every cup you sell, but the rent stays the same.
So the more I sell, the more profit I keep from each additional cup because the rent is already paid for.
Exactly. You've nailed it. Shadowfax has already paid for its stand, its tech platform, its hubs, its corporate team. Those are largely fixed costs. Now, as their volume explodes, growing 68%, their fixed costs aren't growing that fast. They don't need to build a whole new app for every new order.
So that extra revenue flows straight to the bottom line.
That is operating leverage in action. And it seems like it's kicking in for them in a big way right now.
And this is driven by a mix of those revenue streams we talked about earlier.
Yes. And it's really important to break those down because not all revenue is created equal in this business.
Right. So you have the express parcels first.
That's about 45% of their revenue.
Mm.
Your standard e-commerce delivery. This is the mature, profitable engine. It's steady, it's reliable, it's the cash cow.
And then the hyperlocal stuff, the quick commerce.
Hyperlocal and quick commerce is about 20-30% of revenue. This segment is growing incredibly fast. We're talking 75-80% year over year. But, and this is important, it has lower margins right now.
Why is that?
It's just intrinsically expensive to deliver something in 15 minutes. You need a denser network of riders waiting around. You can't batch as many orders. It's a speed for margin trade-off.
So they have a steady cash cow in express and a fast-growing, slightly hungrier calf in hyperlocal.
That's a very good analogy. And then there is the DTC segment, direct-to-consumer, which is their fastest-growing segment overall. And finally, you have value-added services, or VAS.
Value-added services, what falls under that?
Things like same-day delivery guarantees or that specialized complex reverse logistics we talked about. These actually account for a huge chunk of revenue, 40–45%, and they have much, much higher margins.
Why is that?
Because people will pay a premium for speed and for someone to solve a complex problem for them. Getting a return handled smoothly is worth paying for.
So the strategy seems to be use the massive volume of standard parcels to cover all the fixed costs, to pay the rent on the lemonade stand, and then make the real high-margin profit on the complex, high-value services.
That is the playbook. And it leads us directly into where they're going next. Because an IPO isn't the end of the road, it's usually the start of the pressure cooker.
Absolutely. The investors who bought in last month are already asking, okay, great quarter, but where is the growth coming from in 2027, 2028? So let's look at the growth drivers. What is fueling this engine going forward?
I see 4 main engines firing here, and they're all pretty powerful. The first, and maybe the most obvious, is deepening their hold on the quick commerce category.
This 10-minute delivery craze.
It's not just a craze anymore, it's a habit. The data shows the sector is projected to grow at something like 50–62% every year through 2030. That's just a massive wave, and Shadowfax is riding it with clients like Zepto and Blinkit.
It's amazing how quickly that became normal. I mean, I remember when 2-day delivery felt like an absolute miracle from the future. Now, if my groceries aren't here in 20 minutes, I start getting annoyed.
That consumer behavioral shift is Shadowfax's biggest tailwind. But the second driver is actually geographic. It's the Tier 2 and Tier 3 cities.
Right. This is moving beyond Mumbai, Delhi, Bangalore.
Correct. The metro market is still big, but it's getting saturated. The real untapped growth is in the smaller towns and cities. That's why Shadowfax doubled their PIN code coverage specifically to capture this market.
And what are people in those towns buying?
They are seeing huge demand for low average order value categories. So things like fashion, beauty products, accessories.
So someone in a small town ordering a lipstick or a kurti for a few hundred rupees.
Millions and millions of them. And because online retail is still only 7–8% of total retail in India, the runway there is just massive. The open market, the offline world of shops and stores, is still 92% of the country.
That is a staggering stat every time I hear it. Only 8% of retail is online. There is just so much room to grow.
It's huge. The third driver, which we touched on, is DDC and social commerce.
This is the Instagram sellers, the Shopify stores.
Yes. Traditional brands are finally going online direct to the consumer, and small sellers are using social media as their storefront. Shadowfax is offering them enterprise-grade logistics. So a small seller in Jaipur can now offer the same fast delivery, the same tracking, the same returns process as Amazon.
That's a really powerful value proposition. It democratizes the infrastructure.
It really does.
Yeah.
And finally, the fourth driver is premiumization.
People being willing to pay more for better service.
Exactly. Time-sensitive, high-value deliveries. As the Indian consumer gets wealthier and busier, they are more willing to pay for certainty. I need this delivered today, and I need to know it won't get lost or stolen. That creates real pricing power for Shadowfax.
Okay, it all sounds very rosy. They have the tech, the scale, the market trends are all in their favor. But this is the deep dive. And we don't just do the cheerleader routine. We need to look at the dark clouds on the horizon.
The paranoia.
Yes, the paranoia. I love that the management itself has used that word. What keeps them up at night? What could go wrong here?
The biggest risk, by far, is what I call the frenemy dynamic.
Frenemy. Friend and
Look at their cap table, their list of investors. Flipkart is a major investor, but Flipkart is also their single biggest client.
Okay. That's a complicated relationship.
It gets more complicated. Flipkart has its own in-house logistics arm, eCart.
Okay, now I see the problem very clearly.
The existential threat is that clients like Flipkart, Amazon, or even a fast-growing player like Zepto could decide to take their logistics fully in-house. They might wake up one day and say, you know what? Why are we paying Shadowfax a margin? We have the volume, let's just build our own fleet and our own tech.
So if Flipkart decides to move its volume from Shadowfax to its own internal eCart fleet, what happens to Shadowfax?
If Shadowfax loses one or two of its top clients, they could lose 30%, 40%, maybe more of their revenue overnight. And that density we talked about, that beautiful, efficient network.
It collapses.
It collapses. The cost per delivery shoots up. The whole model starts to break down. It is a true existential threat.
So they are constantly dancing with a partner who might decide to stab them in the back. commercially speaking, of course.
Or at the very least, just stop dancing with them. And that's why the management says they have a huge paranoia about innovation. They have to be so good and so cheap that Flipkart looks at the numbers and says, you know what? It's not worth the headache to do it ourselves.
They have to be the best, most efficient option, always. What about technology disruption? We talked about their AI being a moat, but is there something better coming?
There is always something better coming in tech. The obvious sci-fi threat is drones or autonomous delivery bots.
Right.
But even short of that, what if a competitor, a new startup, comes up with a slightly better algorithm? An algorithm that optimizes routes just 20% better than Shadowfax's.
In a low-margin business, being even 2% worse than the competition is a disaster. 20% would be a death sentence.
Exactly. Their thin margins would completely collapse. And then there's the simple day-to-day execution risk. The gig model itself has flaws.
We mentioned they rely on 200,000 gig workers every quarter.
What happens if fuel prices spike by 30%? Those workers might decide it's not worth it to turn on the app. What happens if labor laws change and the government says you have to treat these people as full-time employees with benefits?
Their entire cost structure would be destroyed.
It would completely change the business. Or what if there was a massive strike? We've seen that happen with Uber and Swiggy. It can bring the entire network to a halt.
And then you have the simpler operational headaches, I imagine.
Oh, constantly. Things like failed deliveries. If the customer isn't home to receive the package, that's a cost that has to be eaten by the logistics chain. It's a messy, complex business that involves millions of humans, and humans, as we know, are unpredictable.
It's not just clean lines of code. It's people on bikes, in traffic, in the rain.
Precisely.
So let's talk for a minute about the people running this very complex show. Who is in the cockpit?
The CEO is Abhishek Bansal. He's an IIT Delhi alumnus, and he's been with Shadowfax for 11 years. So basically since the beginning. He's lived and breathed this company.
It's a founder-led team then.
Yes, very much so. It's a young, very hungry team. Vaibhav Khandelwal, Praharsh Chandra, the core founders, have stuck together. And now the board is a mix of these founders and some heavy hitters from the corporate world, like Ruchiro Shukla and Biju Kurian.
And now that they have raised all this money from the IPO, the target was around 2,000 crore in fresh issue, right? What are they doing with it?
This, to me, is one of the most telling signals about their strategy. Usually, when companies go for an IPO, a big chunk of the money is used to pay off old debts or to allow early investors and founders to cash out.
Right, to de-risk.
But Shadowfax is using the fresh fund almost entirely for growth.
They're just paying off their credit cards.
No, the documents show the money is allocated for building out their network infrastructure, leasing new centers, marketing. They're even looking for potential acquisitions to buy new technology or enter new markets.
What does that signal to you?
It signals an incredibly aggressive, growth-first mindset. They aren't playing defense and trying to preserve cash. They are playing offense. They want to use this capital to capture as much of the market as possible before anyone else can catch up.
They're using the cash to widen and deepen that moat we talked about.
Exactly. They're pouring concrete and adding crocodiles.
So we've covered the model, the money, the moats, the risks, and the people. Let's try to bring this all together. As we wrap up, what is the big takeaway here?
If you zoom out from the day-to-day, Shadowfax is essentially a proxy for the growth of the entire Indian digital economy. They are the plumbing. If you believe that over the next decade, India is going to buy more things online from more places, then you have to believe that all those things need to move from point A to point B.
It's a bet on consumption, plain and simple.
It is, but it's a specific type of bet. It's a bet on a race of efficiency. They are winning right now not because they have the most trucks, but because they are using AI to squeeze pennies out of every single kilometer. And they are using a massive, flexible gig workforce to blanket the map.
I have to say, the next time I order that 15-minute grocery delivery, or I return that shirt that didn't fit, I'm going to have a very different appreciation for the invisible ballet that's happening in the background.
You should, because Shadowfax's AI is likely deciding right then and there which gig worker gets that job, what the most efficient route is for them to take, and ensuring the driver knows exactly where your specific gate is, not just your building.
The IPO marks a real maturity point for them. They have proven the model can work. They are profitable now. But as you said, now the real game begins. They have to prove they can survive the giants, the Amazons and Flipkarts of the world who might try to eat their lunch.
That is the challenge ahead. The paranoia has to continue.
I want to leave our listeners with one final thought to mull over. We talked about how Shadowfax covers over 14,000 PIN codes, which is incredible. But we also said that a staggering 92% of Indian retail is still offline.
The open market.
Right. The local Kirana store. The rural artisan making handicrafts. The grandmother selling pickles from her home in a village. The unanswered question for me is, can Shadowfax digitize them? Can they build the platform that connects that massive, chaotic, offline India to the digital economy? And can they do it fast enough to stay ahead of the drone fleets and the in-house logistics of the tech giants?
That is the trillion rupee question. The race for the real India, the 92% that's not just in the metro cities, has just begun.
And for now, at least, Shadowfax seems to be in the pole position. It's going to be a fascinating race to watch.
That's it for this deep dive. Thanks for listening.
Thank you.